Hey guys, welcome back. Today's Sunday, June 7th, 2026, and let's jump back into how I'm assessing the market and some individual names before the storm, or if you want to say after the storm. But today we're not going to simply do a technical analysis of each index, sector, mega cap, and biggest movers. Instead, let's focus simply on the micro E-mini S&P, the MES, and the VIX to get a sense of how to go ahead and look at this weekly forecast. And quick disclaimer time, this is not financial advice. This is for educational purposes only. This is how I'm reading the market, managing my own portfolio, and thinking through trade architecture. Please hit subscribe to follow for more. I really appreciate that. So to start, I want to look at the micro E-mini S&P 500 stock price index futures, particularly looking at points of control in the value area using volume profile. And of course, we could also use the ES, but since a lot of traders watching our retail, we can stick to the MES. And of course, we start with the daily chart. So let's go to that here. And we can see that we lost the super trend. This is, again, a very common study on TradingView, and we've coded it to be in Thinkorswim using ThinkScript. And it's really important because we called that top there about 2 days ago. Again, I'm not in the business of calling tops, but I am in the business of making sure I have hedges on when it's great to do so. And so breaking that super trend did validate that hedge, and we took some profits on it. But let's actually look through the volume profile now. In fact, we actually did call that based on the SPY, but the technicals were the same on the futures there on the daily. It's really great when you have that. Sometimes you can see the futures front running things, but in this instance, there wasn't meaningful edge there. But let's look at the volume profile, because that's what I really want to talk about, because there's something interesting here which can give us a few different clues as to where we're going in the medium term, not just where we're going tomorrow, and nobody quite knows, but there are a few interesting things that I'm seeing. So in the volume profile here right now, you might notice that it's hard to see it, and that's because it's way down here because I'm on the daily, and it's saying this is the point of control based on the time interval that's chosen. And if you see in my time frame, the time interval is 1 year, so it's the daily, but over the aggregated period. So each candle bar is a day, and it's over the time interval of a full year. So this is where price traded the most over the last year. So it is interesting to know that. But what I actually want to look at is the weekly points of control. So again, if you guys want to see more Thinkorswim videos about indicators, just please let me know. A few people have requested it, but I want to make sure there's enough interest and people specifically using Thinkorswim who want to know about these things. But the first thing I'm going to do is I am going to go to a different drawing set so we can get rid of some of my fibs and everything like that. Actually, let's leave those on. Let's just edit our studies that we are seeing. So if you go to studies here and we edit our studies, I'm going to do two things. I'm going to take off a few studies. We don't need to see super trend for what I'm doing, even though I love it. So I'm not going to delete it, just hide it. And pivot points we don't need to see as well. And then on volume profile, I'm going to go through and I'm going to change the time per profile. Which right now it's on chart. Like I said, my chart is set to a year. So it's showing volume profile for the full year. But let's go ahead and look at the weekly volume profiles. So I'm going to click OK here and apply here and click OK. And now we're going to start to see the volume profile. And they're a bit chunkier, but they give us a lot of information here. And what I generally am looking for are points of controls that haven't been revisited. And when you have a bunch of them in a row, oftentimes it's more likely that they are going to get revisited. And so right here, it's not odd that we came back, tested this, and fell right through it because we hadn't tested the second one. But we got very close. In fact, I mean, to the T, that's where we found support right here at that point of control. So it's very interesting to know. And I would say that our next downside target there based on this is also this other point of control around 7,200. And the interesting thing about 7,200 is it's a fib extension from some of the more recent moves that we had. And it's also a breakout point down here as well from a previous move that we had after the initial breakout. So 7,200 is looking like something very compelling to me. And also, as I said, in points of control, when two pivot points aren't touched in a row, it's more likely that we'll revisit both of them, which we just did. So that is fitting nicely with that statistic. So now let's switch over to the VIX, because there's a lot going on to the VIX. And since we're talking about statistical measures here, this is a very interesting one. And, you know, we're seeing a very well-known statistic here, which is that if volatility is up by more than 10% in a single session, you carry basically an 85% statistical probability of seeing an up day in the S&P 500 within the next 2 trading sessions. But the VIX was up way more than that. I think it was like 35%, something like that, 39% in a single day on Friday's close. And so the probability is actually closer to 95% of an up day in the S&P in the next 2 trading days. And we can also see a clear RSI divergence here. But I tend to see them a lot stronger when you look at the 4-hour on the VIX. So that's where I tend to go for that. I also trade a lot in the 4-hour anyway on futures. But if you see right here, where is that? That's much stronger divergence here. They are subtle indeed. But we're going down and that is going up. So right there, I would have started to look for it, but I think we found it anyway in the RSI divergence on the S&P. So this was a little bit less necessary, but these tend to happen when the RSI on the daily and the S&P are coinciding. So what do we do with that information? Well, let's jump back into the SPY and talk about weekly expected moves and daily expected moves, because that's the other piece of this puzzle. You know, I like to look at the the points of control. I also like pivot points, but I won't get into that in today's video. Actually, maybe we'll touch on it just briefly, but I like to look at the points of control and where we may be revisiting. And as you just saw, that played out to a T on the futures. So that is kind of a wild statistic to look at, and should be something everybody is looking at if they're seriously trading on intraday data or even building out longer swing trades. And so the other thing to look at are these weekly expected moves. And I don't always put these in here. Thinkorswim isn't the only program that I am using. I have, as you guys have known, I have a lot of proprietary programs here, a lot of coding that goes into this, and I'm getting my daily moves reflected, because the expected daily moves and expected weekly moves and the expected monthly moves and expected yearly moves can change. And it just depends at what point you have pulled it. I'd like to do my weekly moves at the start of the week. I like to do my monthly moves at the start of the month, but then I also measure how much they've changed. So for example, the upper monthly band, which was calculated at the beginning of the month, was 782, basically right on the nose, which what's interesting about that is that's not super far off from the upper pivot point. And again, these are calculated on volatility from the day before. So that's not out of the realm of possibility, although it's not my base case here. Although if we did go up there and then flush down, that would be a crazy situation. But the upper weekly band, which sometimes I calculate ahead of time, and you can also see what the upper, meaning like 2 weeks back, just because it's easier to do that now with the amount of options that are being issued in the market for the indexes. It's a lot easier to see what the weekly move is for next week and the weekly move for this week. And so the upper weekly band is 751. And let's go ahead and see where that is. So it's basically back up to Friday's high of day. And it used to be 767. So last week, the weekly band was 767. So right up here. And in fact, that on the super trend, it does calculate something very close to that, where it would need to reclaim. And so that is, to me, 2 levels that I'm watching, but then also the lower weekly band, the 723. So 723, the pivot points, actually quite close. So this is a very, this is going to be a huge watch for me. If we come down to 723, I might be interested in some longs, or if we go slightly below it, looking for reversion back up to it. And the lower monthly band, the funny part about that is because the monthly band was calculated a few days back, it's at 730. Which is roughly our other pivot point. So that's one of the reasons I kept these on. I don't want to go through how those are calculated, but when they coincide with some of the monthly bands, they become very interesting levels to me, and it's what the institutions are watching. They're not just simply scalping every move. They're looking at a lot of these to position best for their clients. So given the VIX statistics and the nature and the lack of clean market structure that we saw on Friday's move, I think I showed you guys that just straight down. And in fact, the smaller the time frame you go on, the crazier that starts to look, just like algorithmic VWAP riding down. Not a whole lot of structure. So moves like that, squeezes up, are not unusual. So I am watching that, and that is something to check out, especially given what I just said about the expected moves. But most of the upper expected moves are quite higher and the lower expected moves are much closer. So I wouldn't, and as we talked about the pivot points, there's some untested below. The base case is not that we're just going to go sky high. But it's what we do once we bounce, specifically if we bounce back up to some of these earlier levels in the S&P or particularly in the MES, because that's actually what I'd be watching more closely here. Maybe getting up to this other point of control that we sliced right through like butter. But from there, I might be looking for another path down. In fact, what ends up happening on things like this is people get excited, but you might just see the right shoulder starting to form, especially because the 20, this is the 20 SMA is starting to flatten out and might go down. Sometimes you get these pumps back up, which form the other shoulder, and then we come back down to the expected move down here. So 7,200 is something I'm watching closely, but that's not end of days for me. If we hit that, that's like a relatively expected situation, but I might be playing the bounces on the way up. The other thing to think about is that the Bitcoin has started to bounce over the weekend. So I assume we'll get some semblance of that when the futures start in a few hours. But if we do bounce, like I said, I'm going to be looking for some of those overhead levels as a point to head back down. And I won't be looking to aggressively short them, but instead my actual play, given the situation, is to have a tight stop loss, scale out of long exposure on the way up, and let the market come to me. They're very specific scalp moves for a very specific statistical play, meaning, what I said about VIX and the likeliness that we'll have a green day. But that's all I'm going to take it as. And if you want the complete read of exactly what happened on Friday, please go back to Friday's video. I think it'd be helpful as a supplement to today's video as I'm talking about some of these pathing possibilities. But do stay nimble, and if you're going long, tight stop losses. This is not financial advice, but meaning that's what I would be doing. So let's look at some actual trade ideas and swings and hedges here, because now that I've covered one specific way to look at the market in general, and as promised in Friday's video, I'd like to check out some trade ideas for the week and where I'm allocating capital across 3 different timelines. So scalps, swings, and long-term. So the scalps are a bit easier. We mentioned the bounce that we can kind of expect at the open of futures and on Monday morning in actual equities. And, some of that actually tends to play out in the overnight. And I also am expecting a bit of volatility in general. Volatility has entered the conversation. So I'm not expecting this to be a straight up, straight down situation anyway. Even if we get a bounce, I don't think it's going to wipe it out. However, last year, a few of these crashes did end with straight reclaims, just squeezes depending on the positioning. So that's not out of the realm of possibility here for me, particularly these gigantic moves on the RSI. But we still have plenty of room to run before this becomes a downtrend. And in fact, in the weekly, what I really like about this, and I've had some alerts going, I don't quite think we hit my first alert there. This is pretty healthy in in the scheme of things, so we can go a lot further before the trend has changed. So scalps are going to be a lot easier in the futures for me. But since we mapped out a clear game plan there, let's look at some of the things on the swing watch list. So we talked about this last week, and we did close some hedges, but we're monitoring our hedges in general. And SOXS is now our primary inverse semiconductor hedge based on the probabilities we outlined in the VIX. We'll add on to SOXS as SPY hits our primary overhead levels, meaning as MES starts to reclaim certain things. Let's go back to the hourly here. It wouldn't be odd for me to, it wouldn't be unexpected to come back up into the 74 area, 74.20, something like that, at which case I may be adding a little bit to SOX here and there. And we're going to add to that as SPY hits our primary overhead levels. And then likewise, we'll start taking some profits as the hedge as we hit downside targets on the S&P. So if the S&P starts to come down into that 7,200 level, we're not just only going to be going super long, we're probably going to be taking some profits on SOX, as I imagine that will have had the inverse effect on that. And of course, if we absolutely dump out for some kind of black swan event, that's the other thing that I don't think is the base case here, because I think this was a technical pullback rather than actual macroeconomic repricing. I think that could have been the excuse, or at least to shake out retail traders. But I actually think this is a much more technical pullback. And if it does become a larger pullback, it still can be technical. I mean, we had just straight up for so long. This is atypical, this run. It wouldn't be odd to have a few red days there. But oftentimes after a day like this, you will see a little bit of a pump back up. But be ready for anything, of course. But my point is, if we absolutely do see a black swan event that this was just some kind of precursor for, we still have our hedges going there, particularly on hedges that expand as they go up. So that's something I do like about these leveraged ETFs. But again, once it climbs, that can have an adverse effect on your position. So it definitely wouldn't be crazy for more downside and still stay in a technical uptrend, particularly if we look at the weekly or if we look at even the monthly. And the monthly is looking mighty fine here. I'd probably be looking to go a lot harder if we come back down to 690. But that's a different conversation because context matters and it matters how we get there. So I don't want to make sweeping, assumptions about what I may or may not do when we reach those levels, but I'll definitely be looking for it in the next few weeks as a potential entry if we come down there. So those are the swings. But I also mentioned in some previous videos in the software space, and many of those are still on, but I don't expect so essentially Microsoft, which we were looking at, and actually on the monthly this still looks great to me, and I think on the weekly it's still looking good. Hasn't reclaimed that, but we are seeing a lot of volatility in that, which is great if you are day trading these. But in general, I don't expect the software space to just go have massive up and to the right action on those tomorrow or this week, really. We could certainly get some bounces on position for the massive moves in that. Microsoft, ServiceNow, as we talked about, even Meta. These are all following a similar theme that we're playing out, and some similar digestion on these charts. But there's CPI inflation data dropping on Wednesday, and I think there'll be less like to the moon single names in the software sector, but if a massive move should happen, it'll be definitely captured by the structure that we have on some of these names. Plus many of these are long-term holds, which we'll talk about in a second. So next I want to talk about long-term, including some non-traditional long-terms. So I'm going to talk about some differing approaches in the long-term portfolio. I don't just look at straight up technicals and fundamentals. I also look at macroeconomic, geopolitical, environmental, and fundamental analysis that extend completely outside of the chart. And so I mean non-traditional alternative data like weather reports, political filings, and corporate catalysts. In general, traders are always worried about the near term because through leverage, we can all make significant money in just a few days, or even a few months. I mean, SOXS again, or what we had last year with gold or silver. These are the kind of things that people get really excited about, and they're looking for these breakouts. But if you had been doing your macro analysis maybe 2 or 3 years ago, you wouldn't have had as much screen time or as much risk in order to capture these moves. You can actually set yourself up for true generational positioning. So essentially we can get some huge short-term swings like what happened on Micron or Marvel or like we were just talking about. But had you planned those moves like 3 years ago, you'd be up much higher than if you were just leveraged right here. Well, maybe not much higher if you were super leveraged here, but much more safely and not necessarily needing leverage, although you could have also planned that out to some degree. And also let me know in the comments if you'd like me to do a dedicated video on that. But here are a few things these non-traditional data sources and how to kind of model this stuff out a few years ahead of time and how you would make that play happen. But here are a few that I've been watching. And so my models are specifically pointing to some huge undervaluation in food and water infrastructure, specifically Conagra Brands. And we talked about this before in some other videos, and Essential Utilities, WTRG, and Algonquin Power and Utilities, AQN. And so this comes as a result of as a result of a confluence of factors. So the geopolitical, environmental, and core fundamentals that I was talking about. And in the case of plays like essential utilities, they also have not just strong corporate, strong factors, a strong confluence of those factors, but they also have a strong corporate catalyst since they're essentially being acquired by American waterworks. And, I don't think that's something enough people are paying attention to, not just this specific play, but as we were talking about alternative data sources and corporate actions, that's a little bit beyond what a lot of day traders are thinking about, but they are some of the most powerful moves that you can get. I mean, it's a fundamental repricing, rethinking of a business. And so those often you need to be positioned well ahead of. You can't just ascertain those based on the technicals as they're showing up in the chart, although some people believe that you can. And in fact, if we look at water, WTRG, essential utilities, what I really like, if we see this, right now we're on the weekly and we've been consolidating, this is a huge RSI divergence. And so again, this is not financial advice, but these are the kind of moves people are not going to give you on YouTube. Not to say I'm giving you something amazing here, but I don't see this kind of analysis. So we have a weekly RSI divergence that is, actually we don't. Let me go out, sorry. No, yes, we do. Okay. So these allocations also, water, WTRG, Algonquin, and Conagra. What's also special about them is they pay high dividend yields. So it's not the main reason for entering, but it beautifully cushions the waiting period and slight equity downside. So value investing 101 is kind of your best friend here. But again, it's based on alternative modeling rather than just basic price action and earnings reports. But I'm really liking these. So one thing to show you here is Conagra on the weekly. What I really love is, and this is kind of thing where I don't think a lot of YouTubers are going to give you this information. And again, it's not financial advice. It's just assessments of the markets. We have this really great divergence here. Some people are going to do it from here and say there's not divergence, but I'll do it even bigger time frames. And in fact, we could probably even do it on the monthly to see it here. It's probably a slighter divergence. Yeah, where you have equals, but the price is moving down significantly. So that's something that I'm watching. And as I said, and you could even look at it from here, and that would be a very nice, let me change the scaling here. That would be a very nice divergence. Oh yeah, I'm liking that quite a bit. That's a much longer term thing. And plays like this, these are being acquired by institutions and pensions and retirement funds, all of that kind of thing. So they're okay to just average into those funds over a very long period of time. So I'm liking that. So again, Conagra, AQN, WTRG are things in this this form that I'm looking at. Great. So if we're talking about environmental factors, another thing I called out was end phase as a prospective entrance, and still looking great to me. So let's talk about a few things first. First, let's look at their monthly chart to see how we are looking. A few things I noticed is that we're sitting right at the pretty close to the historical point of control right here. And as I said, this is, we had set it back to be the time interval, not time interval. Yeah, the time interval of 10 years here, because it's based on whatever the chart is set to. Let me change my mouse function here so we can zoom back out. So I'm really liking that. That's not a bad entry point, and you can actually see that I've had an alert going here for quite a while. So if it comes back down to there, I'll be really liking it. But if we actually look at some fundamental factors here, that's another stock we'll be talking about. If we go ahead and look at the forecast, the EPS and the revenue are doing something interesting, which I really like. And we could see that they've taken a hit and are fundamentally projected to be down for the remainder of 2026, but then thereafter they're going to be re-expanding. And that's completely consistent with something I'd like to be considering for a long-term hold. So this is something I'd be playing with shares and long-term leaps. I can completely see a compelling case for selling cash secured puts to get assigned and drive my cost basis down while simultaneously buying long-term leaps to add convexity. I want to get my underlying cost basis down to close to something like $40 because that's, like I said, where we've been trading over the last 10 years with the most volume. And that's compelling to me, specifically when EPS is going to be expanding again. In fact, if we look at this, we hit some of those highs in 2023. And of course, what was happening? EPS had expanded the most and was starting to contract. So of course, that's the highs similar in EPS. So I'm eyeing this for some entrances here. And in fact, if we look at the options chain, because this would be a long-term play for me, I'm looking at something like the 2028 of January 593 DTE, and the spreads are not that bad given that and that we're in after hours here. So I like that as something perspective. And a lot of times also with this, what I'll be doing is a call debit spread with a ton of time. So again, maybe I'm looking at the 40 and something like the 80, a really wide spread. And the way that I would be thinking about that is that if I'm incorrect and we go down further, like let's go back to the charts here. If we look at this on the daily, it does have a lot of room to fall back below that point of control because that was over 10 years. And that point of control on the daily, which is just looking at 1 year, it's saying the point of control is at $35. So coming back down to there wouldn't be the weirdest thing. Right? Especially because this is lining up with the 200 SMA. So if I wanted to get into this now and just kind of set it and forget it and manage it occasionally, I would probably be going ahead with a call debit spread where I buy the 40s and I maybe sell the 80s. And if I'm incorrect and we come back down to 35, I will close the calls that I've sold. I'll close the short leg for profit to help fund the long leg. And again, I do this quite a bit. It's one of the main plays, but it does require a lot of active management to do that. But it is also a longer term play. And the other thing is selling cash secured puts there so that I can get assigned and hold those for a long time because I do like the valuation of it down here. And I have a different thesis on how ENPH is going to play out based on some non-traditional data that I've been modeling. And so let's move right ahead to the next wave of future computing and energy infrastructure. And so I've also been building out quantum computing exposure, mostly through just a few different names, Defiance Quantum, Inflection Inc., INFQ and Rigetti. I'm liking at some of these levels. And I'm also have a few other positions like Qubit and QBTS, D-Wave, but I'm holding those in the Roth because I think they're going to need a long time to play out fully. And so I'm systematically using URA, the Global X Uranium Fund, to also gain exposure and small modular reactor because I see this future of computing and energy infrastructure to be correlated. And so I am treating them as a similar play for sure. And I'm holding them, like I said, in the Roth for a lot of it because I truly expect a lot of volatility and more times to add to these positions. So I'm sizing them small and accordingly and giving them a lot of time to play out. Another thing I'm thinking about is building out few equity names based on inclusion in major indexes. So I'm currently watching, I'm also holding SoFi. SoFi I'm holding in a number of ways, and also BMNR. We talked about these in some other videos. So I'm in those names, but something like Reddit has had discussion about other indice inclusion. I'm watching this more closely, but I have less conviction in this play in general. But it is something I wanted to flag as something potentially to watch. And if people seem to be quite interested in this as a recent play, but to me, I have less conviction in it, mainly because I can't see how institutions are reacting to it over the long term. But that's just something to call out. And then obviously for, this, we talked about this before, but Microsoft, ServiceNow, Meta, and particularly Meta, I guess, just based on what happened last week with, that capital issue, or I wouldn't even call it an issue, but just raising capital. And the market absolutely hated that when the news came out. But I think sentiment was already low for the day. And news like that sometimes does shake out a few more players. But my point about these is these are all long-term ads for me in general, based on core earnings and fundamentals and how those figures are corresponding to the current support levels. So we covered some of those trades previously, but nothing has changed really for me. This consolidation zone, while it may feel very, and this is meta, while it may feel very volatile, it's not that. It's not that big of a move. It's still range bound here. So my thesis hasn't changed with those and what that feels like on, a 6 month. In fact, you can almost see these as pullback in times. The 200 SMA is slowly catching up. Let me go to a daily on this. It's starting to flatten out here a bit. So this isn't a problem for me personally. Again, not financial advice. And so now let's get into a few that are a little bit less talked about, even though I'm sure, like when I was talking about water utilities, and there are others, but I don't want to cover my full portfolio like Xylem. I still have a lot of faith in, but this is more tied to technology. So that could be an interesting play, but it's going to need a lot of time to play out. But so a few that are a little less sexy and people aren't talking about. One is Clorox. And I'm not in this yet, but I am starting to look for entrances here. So it flashed for me on a nice series of consecutive weekly RSI divergences. So if I go to the weekly here, this is like one of those premium spots that I'm looking for. So we have a weekly divergence here that just keeps going. And to me, that is like the hallmark of institutional buying here. They're scaling in, essentially, is what I'm seeing. And then when we had earnings there, you got that final dump. And now what's also happening is we're starting to tighten up and consolidate after that. So on the weekly chart, like I said, we're finally seeing some RSI divergence that's hard to ignore for me. And something else to note is the RSI here, because plays like this, depending on how you're going to play them, that ATR is really important for me. So there's enough implied volatility and expansion in this name, because it is going up, the implied volatility for sure. But that is for a few reasons. It's not just because of the divergence I'm talking about. But that expansion on the ATR is important to me because we have been consolidating. These moves are a little bit smaller. Let me change my mouse function back over. Than some of the dump moves. And now we've had this series of inside bars, or essentially consolidation over the last few weeks. But when this thing moves, it has enough room to move. So sometimes when people get into these beaten down, like consumer discretionary or consumer staples, not discretionary, sorry, consumer staples, they are putting on huge call positions, but the ATR doesn't really justify that kind of move, and you would have to wait for a very long time here. That's not necessarily the case with Clorox. And also Clorox does have where's their dividend here? It's a 4.7 dividend, at least according to Thinkorswim right at the moment. Sometimes that dividend is off a little bit. But it's one of those kind of things that's looking really good for that kind of play. And if we look at the weekly, the point of control here, and I think my weekly is set to a time frame of 3 years. Let's go to 10 years here. We're still, even on 10 years, way below the point of control here. So to me, this is just some deep value investing. You have to look at how their figures are reporting. And let's go ahead and look at Clorox on the forecast and the fundamentals. And this is having a similar situation here where 2026 revenue is going to be going down, but this is very cyclical. We could see that from previous, whereas their revenue actually hasn't dipped quite as much. It's earnings per share. So there's other factors going into that. And probably less execution and more overhead and just margins tightening on them. But I am looking at this currently. And so for me, this is another one where and also let me put this back on the weekly here. Because what I really like about this, and again, I'm going to change the weekly time frame to 10 years, and I'll show you something here that is interesting to me, which is that we fell through a few, and maybe it's even better to show you on the daily. I think so. If we do the daily time frame, at least a year here, we fell through some pockets of liquidity. And it's probably actually even best if we put it on the 20-year, believe it or not. This is one of those stocks where you could see that best. And so Thinkorswim is freaking out because it's a ton of data points. All right, so downside target here for me we're getting very close to. So these are one of those things where selling cash secured puts down at 60, which you're probably not going to find a lot of money on unless you're selling out till next year. But you kind of want to scale in with that in mind. I don't think we're actually going to get there, to be honest with you. In fact, on the daily, things are looking mighty fine. So this is one, and we have, do we have any divergences here? Much longer term, but I think that's going to be similar to what we saw on the weekly. So before I get more, before I get more, and this fall here, I guess this is the point I was trying to make earlier, is something that is happening because of a liquidity pocket. It's just an air pocket here. And what happens is you fall right through it. People buy it right back up. There's not a lot going on. I think if we are able to reclaim some of this, we might come back all the way up to the 200 SMA. So sorry, that one was a little bit longer, a little nuanced. And I also want to show you that I'm doing a lot of this with you guys. This isn't just, like stuff I'm finding online. These are charts that I'm analyzing along with you. And so to continue on, let's also look at Blue Owl. This is another one, and I've actually been adding capital to this over time because I don't think private credit is going away. I generally think that retail sentiment is in the dumps on these. There's been a lot of private credit issues, but this is a name I've been watching closely with all of that. And so interestingly here, you can also see that RSI divergence. This was building up again on the daily for quite a bit of time. In fact, that I got in when we proved it around $10, something like that. What's my cost base is $9.69. So maybe I got in here right after the buy. But this is something that's going to need to take some time for me because again, it's in the dumps. But it has a phenomenal year-over-year EPS growth. So let's go to that on here. And go to the forecast. This is not something that's slowing down. This is something where sentiment is in the dumps there, and people were concerned. And I don't think that is something to, discount. But at the same time, it is compelling to me when I start to see that EPS growth, revenue growth are in, at odds with popular sentiment about these, and coupled with the RSI divergence that I saw, and also coupled with the fact that the dividend, this is a strong dividend play. So it's paying out 9.9%. And that'll change as the levels change, but there's no need for me for options convexity here. It's an investment. It has a low nominal price, so I can easily dollar cost average in down here. Just essentially, I'm investing some of my money, putting it here for the longer term, and also because there is less nominal downside. Meaning, if you fall from $10 to zero, it's a lot different than falling from $300 or $400 to zero. But also the dividend is going to help mitigate some of that downside. So those were most of the trades. I also wanted to mention that in that same camp, I'm looking at BN, Brookfield Corp. And, BN is an interesting one because it's heavily engaged in real estate and energy. And on the monthly chart, they've been, kind of like eating away at some of the upper liquidity, if you see it. So yeah, on BN here, these wicks up top are interesting to me. It means, one, people were unloading up there. They were hitting institutional take profits, but also we didn't tank after those. And given some of the macro, I'm actually surprised on that. So it's something I'm watching, but I am also looking down here on the fib retracements for something around like 35, 34 to actually build a position. So this isn't actually a trade idea. This is more like an interesting one on the watch list I don't think a lot of people are talking about. Great. So that's a lot of different tickers and prospective trades that I'm watching. So let's go on to looking forward for the rest of the week. So looking forward for this week, we're getting some huge data. Wednesday, let's go to it here. Wednesday, we're getting CPI. Where are you there? Yeah. Okay. So that is a huge one in the macro data points that typically move the market a lot. And funny enough, and so then on Thursday, what's funny is we are going to get PPI. And a number of other things, but those are the big ones. And the funny part about that is that they typically move counter to one another, meaning if one causes the market to go up, the other one's going to cause the market to go down, and likewise. So it's kind of interesting thing. You can go back and look at historical moves and notice that. So just something to keep in mind, but I would keep that more in mind after Wednesday. And it's also okay to not trade either of those. A lot of people save more money by not trading. So then on Friday, we get the, where is it? Yeah, there it is, the Michigan Consumer Sentiment, the preliminary numbers. And that usually creates more of a clean trading day. So the moves from the data tend to be less choppy once the data drops. So Fridays are usually better trading days for the average retail trader than some of the larger data drops. So you got to be careful on those. I mean, these could be huge moves for sure. So to wrap that up, I guess what I'm seeing, I'd rather be building long-term positions in stocks that are completely uncorrelated to the AI trade or who have been beaten down already with less room to fall. And, if they are correlated to the AI trade, either by way of being a hyperscaler or being a heavyweight in one of the major index ETFs, I'm strictly favoring those with true fundamentals who are at or near 52-week lows and who I'm perfectly happy to hold through near-term volatility. Some of those Microsoft plays, for example, this is a longer-term thesis, and it's not behaving, it hasn't been behaving similar to the S&P or to the QQQs. So that's the kind of trade I'm talking about, and we've kind of mapped this one out in a number of videos. So that being said, in high volatility week like this, a lot of money is being made via not losing it. And that was probably the case this last week, when we identified some of these divergences. It was better to not go hard long because the upside potential was less compelling than the risk of downside here. And so, it's perfectly okay to wait and reposition after the larger money has repositioned, particularly if you have multiple portfolios. If you have long-term holding portfolios, you're not going to miss out on these things. And you're not going to feel like you should have been out there leveraging heavily to capture these moves. So that's why I'm always talking about these long-term ads. Also, if you're not buying when things are super depressed, when are you going to buy them? Only during breakouts? I guess that's that's one way to do it. It's not my trading style. And so there's nothing wrong with hanging tight and keeping your capital safe and waiting for exact structural levels to show up, some of those levels that we mentioned earlier. So that's it for today. A massive thank you to the community members who suggested that we structure our layout starting with indices and individual options execution. I know we did less of that today, but come tomorrow at Market Recap, it'll be a much tighter video, a little less off the cuff, but I also wanted you to see how I'm thinking about that and to hear a trader, who's a seven-figure trader who's also worked at the institutional level to talk about some of this stuff. It's not just like, here's the trades, I mapped it all out. It's more like, here's all the things I have mapped out. How am I thinking about this? And sharing that insight with you in the way that I think about these things. So a massive thank you. Please subscribe and like, and it truly helps me provide these daily videos. And let me know in the comments if there's any other specific tickers, option setups, or think and swim questions you'd like me to cover. I can make much shorter videos just doing one topic, but it's the weekend. Maybe you guys will enjoy this a bit. So trade safe this week, and I'll see you on the active tape tomorrow afternoon.